That we are having today. So sorry about that. Welcome to our webinar, which is Making Sense of Cap Tables. My name is Sirk Roh, and I'm a consulting CFO, and I'm going to be joined here by Alla Ismail of Early Growth as well. So Alla, if you could just say hello to the team.
Hello, everybody.
And again, we apologize. Typically, we have a moderator on who kind of manages the broadcasting and the deck. And unfortunately, she's the one who's having technical difficulties. So hopefully we'll be able to get through this just with Alla and myself. So let's see here, just a little bit about our firm, which is you can see a quote here from our founder, David Ehrenberg. But basically, we are a firm that assists with lots of early stage and small and medium-sized companies with their financial and accounting needs. And basically, we have four main services that we provide. We're, first of all, a nationwide company. We have a team of both CFOs as well as accountants and controllers around the country, across the country. Our four main services are, on an annual basis, we provide tax returns. So we do corporate as well as personal tax returns for our clients. We also do valuations, which, if you're giving stock options, for example, you need to be doing a 498 valuation to value your common stock on an annual basis at a minimum. And so we provide that service. But our bread and butter is in our consulting services. And here we basically provide two different types. We have CFO consulting, which is what Alla and I do. And we provide high-level, basically, high-level financial services to our clients. And we typically team up, in many cases, with a senior accountant who provides accounting services. And so as a team, we'll typically go in for our clients and become basically their accounting and finance department in handling everything from basic bookkeeping and monthly closes to annual budgets and forecasts, and helping with fundraising and looking at debt versus equity. We'll talk a little bit about that today. But basically, any other type of thing that you would typically get from accountants and CFOs, we provide that service, but on an as-needed basis, as opposed to you having to hire people full-time. And even before we really get started, just a couple of notes here. We will be, and you're gonna have to forgive me because usually our moderator is providing this narrative. But at the end of the presentation, we will have a Q&A, time for Q&A. But feel free to pop in and put in any questions that you have in chat. We'll try to monitor that throughout the presentation and try to get to some of those questions and answers at the end. Also, just as a notice, for everyone who's registered, we will be providing both copies of this deck as well as the recording, and we'll provide that to you via email. You'll also be able to find this information if you look at the Early Growth YouTube channel, where we have a lot of past presentations as well. So with that out of the way, let's go ahead and talk about cap tables. So Alla, maybe you could get us started with why a cap table matters.
Yes, I will. But before we get started, one more just administrative matter. Typically, our administrator would mute out everybody. For some reason, we're getting a typing noise. So if you could please mute yourself, and feel free to use the chat function in this presentation to give us any questions. We'll be checking that from time to time just to make sure everything is going on great. But if you could just mute your because typically our administrator would do that, would just mute everybody out so we're not hearing everybody's noise on the call. Okay, so why do cap tables matter? Perhaps in early stages, the one document that might even matter more than financial statements to venture investors or just investors alone is the cap table. One of the typical requests that I get on a regular basis from venture-backed companies are the cap tables. They monitor that very, very closely because it's essentially an indicator of who owns the company, what percentages are being owned by who, what are the stock values, what are the different amounts that were raised. It's super critical in determining who owns what. So in the cap table, it could be very, very simple. So we will show an example later on of a simple cap table, which is essentially just kind of groups the capitalization of the company into buckets, things like preferred, common, and unissued stock options. And then there's a lot more complicated that will kind of dive down to the individual rounds and the individual investors and what their fully diluted ownership or their outstanding ownership. And we'll get into what fully diluted and outstanding share ownership later as well. But the other critical item for a cap table and why it matters is it establishes the ownership value and related rights. So typically a cap table will be separated into sections. For example, like it will tell you who has voting rights, what are some of the liquidation preferences, and if there's any rights of first refusal. In a detailed cap table, those things would be highlighted and outlined. Capitalization tables are important in preparing your taxes. We're getting ready to do the final extension here for the 2018 tax year, and our tax preparers are always asking for capitalization because there are tax consequences for the folks that own certain percentages of the company. So the tax preparers need to know what the ownership percentages are and how to affect that in tax returns. You know, it could matter in cap tables are very, very important in M&A type transactions, or if you're being acquired, so folks could figure out the exit values that are going to be assigned to all the different investors. It matters to you as an entrepreneur because you want to know what percentage ownership of the company is, and will help you guide future investment rounds so that you don't over dilute yourself. And then cap table finally is a critical part of any kind of financial compliance. It's a standard document that's required along with the balance sheet, income statement, and statement of cash flows. So that's why it matters. It's a very, very important document, and it's important to kind of get it right. And to one final thing about cap tables too, cap tables are not only important later when you have several rounds of financing and several investors. It's important to trace your cap table very early on from inception. So as founders of a company, for example, you need to know what your capitalization structure looks like and what your ownership percentages are from the get-go. So capitalization cap tables are very, very important. Sirk? Hello? Hello, Sirk?
Yes.
I'm sorry, were you on mute? We can move to the next slide.
Hello. Ala, can you hear me?
Yes, I can.
Oh, okay. I'm sorry about that. Yeah, okay. So let's talk a little bit about key terms here. So basically, a share is a part or portion of an ownership, right? And so, we'll talk about different share types here, but basically, every the ownership of the company is divided into shares of the company, right? And so you hear that in financial speak. But for us, the way that the cap table is structured, the way that the shares are structured, how many of each class of shares that each individual or each entity owns is going to ultimately determine how much of that company each entity owns. Right. And so there are different share types, right? So there's common shares and then there's preferred shares, and those are the main two. And here we've broken out, preferred into different series, so you may start with a seed preferred round, which would be kind of like that first round of financing, and beyond that, and maybe you don't even do a seed round. Maybe you go straight into a Series A round of preferred. But as you raise additional money in different rounds of financing, you'll do that in different preferred shares of stock, right? So common is and the difference between common and preferred is that as a private company, that you delineate between the two. You delineate between common and preferred. Preferred shares there are preferences, and that's why they call them preferred. So there's typically things like liquidation preferences, where if a company gets sold or if it merges with another company, then preferred shares will have preferences. They'll get money first before common shareholders get money. But ultimately, over time, and as we move towards an IPO, if we ever get that far, then during the IPO stage, in most cases, preferred shares are converted into common, so that they all become one and the same once the company is a publicly held company. But up until then, you do have to understand the difference between common and common and preferred shares. Probably hard to get into all of the details in here, but typically you'll have founders will own common shares, and employees will also get options and to common shares, and they'll own common shares. And investors, people who are actually putting in money right into the investment, will typically get preferred shares. So options and warrants are basically they provide an ability to buy a share at a certain price. So you're probably very, very familiar with stock options for employees, stock options for founders, and that's basically what it is, right? So it allows, it basically says, hey, we're giving you an option, and maybe you do it as part of a compensation package, maybe as incentive, maybe for advisors and board members, to get a little bit of incentive in the game, equity incentive for them to continue to contribute to the company. And so you'll give an option that says you can purchase so many shares of stock at a certain price, and then there are terms associated with that, like how long the option agreement is good for and things of that nature. But basically, they will show up on your cap table as part of fully diluted shares. And warrants is similar, except they're typically given out to entities. So, for example, a classic case for warrant coverage for many of our clients is when we maybe do a venture debt deal. And as part of that debt that we take on from a bank, the bank gets warrants to purchase shares at a certain price point. Typically the same price as the last round of preferred finance investors purchase prices at. Diluted shares and outstanding shares. So we'll talk a little bit about that. Diluted shares is basically your total shares if all of the shares that are that are available to not only be sold, or that not have only been sold, but also able to be distributed, right? So this typically means things like your stock option pool. your warrant coverage, all of those things that are not necessarily where the stock is actually outstanding because people haven't purchased them. But when you're trying to calculate what percentage of the company you own, you really want to do it on a diluted share basis, just so that you understand what's the kind of the minimum. I'm sorry, what's the maximum amount of stock that I might own, or what's the maximum amount of the company that I might own if all of the shares that are available are actually distributed and outstanding. And then the shares outstanding is really just those shares that have been actually handed out to investors and to founders and to, for example, option holders who exercise their option to purchase the shares. Okay, a few more terms. Hold on a second.
I think we covered all the terms.
Yeah, I apologize. Are you able to see? No, my slide isn't. There we go. Okay, and a few other terms. There's a pre-money valuation of a company, post-money. This is, what you look at kind of like, when you're getting a round of financing kind of put in place. The pre-money is the value of the company prior to this round of financing, right? So for example, and this is something that you're going to negotiate, right, with your new investors, right? What is the value of my company before you guys put in an investment? And that's going to depend on things like, how much progress we've made, and how much traction we have, product development, the market size, right, the opportunity, all whether we have revenue and what kind of traction, what kind of revenue growth, all of those things, as well as money that people have put into the money prior to this round of financing. All of those are going to have an impact on what that pre-money valuation is, and it's going to range. And hopefully, what happens is that the valuation of the money of the company increases over time. But then the post-money valuation is basically how much the company is going to be worth after that funding event, right? So, for example, you would say, "Hey, look, I've got a company. It's in an early stage. I can make a good argument for why my company right now, even before you guys put in money, is worth $5 million, for example, right? So maybe this is kind of that first round of financing, and you can make a determination or make a good argument, and there's an agreement with investors that your company is worth $5 million, and on that $5 million valuation, let's say an investor puts in, $3 million, right? And so then the post-money valuation after that funding becomes $8 million. And then the new investors will own, 3/8, right, or 37.5% of the company at that point. There's other instruments of financing as well, kind of going from, we'll start with notes first. At really, really early stages, before you're ready to actually give out preferred shares, you might be able to, or you might look at financing your startup with other types of funding vehicles, including convertible notes, including SAFEs, which is I forget the acronym, but it's basically a similar type of arrangement as a convertible note, except there's no interest associated with it. There's no maturity date. It's a investment vehicle that was created by Y Combinator. I think every single one of their portfolio companies uses SAFEs as their first round of financing, and other companies have started to use that as well. But that's probably for a different discussion or a different webinar where we do talk about differences between SAFEs and convertible notes and other types of financing vehicles. Okay, so Ala, maybe you could kind of walk us through, and I know this is kind of an eye chart here, but maybe you could kind of walk us through a simple cap table.
Yeah. So the one thing that I'd like to kind of piggyback on what Sirk said, that we kind of get an understanding of that a lot of folks have difficulty in kind of differentiating is what the fully diluted shares are as compared to the outstanding shares or outstanding ownership of the company. Simply, the fully diluted shares are all the shares that we've actually issued or folks have invested money in or exercised options, plus any options or warrants that are out there that people have the right to purchase but have not yet done so. So that's the fully diluted, and most people look at the fully diluted ownership of a company because that is essentially the potential ownership structure of the company once all those shares are converted or exercised, or the warrants are exercised as well at whatever point in time. So that's really essentially the difference between outstanding and fully diluted. So in this eye chart, this is a summary cap table that you would typically look. The cap table is divided into the different share categories. So in the top section here, we have the common shares. So the common shares that we've issued are what's outstanding. If there's any kind of the conversion ratio associated with those. So just like preferred shares, common shares sometimes have a conversion ratio attached to it. So that's important to know because that conversion ratio will end up affecting as I mentioned before, our fully diluted ownership percentage in the company. So typically, this is where the common stock shares are input. Restricted and non-restricted. Founder shares sometimes are non-restricted, and sometimes options have restrictions attached to them. So common shares would sometimes come in those two buckets, in a restricted common shares or that have some kind of restrictions attached to it, or unrestricted common shares. A typical example of a restriction on common shares are buyback rights. That's a typical, very, very common in stock options where there might be that kind of restriction attached to the common shares. But there you have all the commons separated. The second section is the preferred. And typically you will see in a summary the number of shares in each preferred category. Here we have Series Seed, we have Series A, Series A1 for a total. So that is the preferred section of our cap table. Will give us the number of shares and what the fully diluted ownership percentage is on the right. And then finally is the stock options or warrants, and those are usually listed out there. And we typically then get a little more granular where we say, okay, here are the stock options that we've totally authorized. Here are the options that have been granted to individuals and employees or issued to them. And here is what's remaining to be optioned, or the pool that's available for grant. Yeah, I'm very, very sorry. I know we're getting a lot of comments about the size of this. We in future we will fix this, but
is that better?
That's a little better. Yeah, a lot better. It's a lot better for me.
My apologies.
This is an example of a detailed cap table. So you usually in a cap table, you'll see kind of a layers. You'll see that summary cap table that we showed, and then a detailed category, cap table like you see right now that lists all the different categories of stock by individual. And then the next level you'll see is each individual category. So you'll see a detail of all the common. You'll see a detail of all the Series C, the detail of all the Series A. But this is an example of a detailed cap table where the names of the investors are listed, the number of shares by type, common, Series Seed, Series A1, to give us the actual outstanding number of shares. And the reason why we total that off is that for information purposes, either for tax purposes, for example, we only want to account for the total number of shares that are outstanding, and we do not want to include warrants and options. So we have a column here indicating what the percentage ownership on the outstanding shares. And as you could see, the ownership in the outstanding shares is a lot higher for folks in the Series A or in the preferred series and the common that have been issued, as opposed to when we move on over to the right and see on the fully diluted basis that that percentage goes down, because now we're taking into consideration option pools. And stock options do dilute, in most cases, do dilute outstanding shares by somewhere between 15 to 20%, meaning a typical stock option pool is somewhere around 15 to 20% of the total share value of the company. So typically you'll see approximately, and it's not, there's not a set rule, a difference of about 20% in ownership between the outstanding detail and the fully diluted ownership percentage. So these are kind of an example of what a cap table would look like. We've left out names, of course, just because this is an actual example of a company, so we don't want to include those. But typically then you will see all the investors and all the individuals listed here. And then the next layer of granularity, like I mentioned before, would be things like a detail for each category that you see up top here. So there'll be a detail for common, a detail for Series C and Series A, and so on. The last thing that you would see in a cap table are items that might affect capitalization. For example, you know, that any potential terms or conditions that might be useful to potential investors might be listed in a note section of the cap table that may not affect the actual ownership percentage right now. But, you know, for example, if the company is currently going through a financing round, and maybe some outline of that would be listed there so the investors know what's happening on that front as well. But this is a really, really good example of a summary cap table and a detailed cap table. Sir?
Thank you, all. Okay, so and I know that it's a very, very high level description. You know, I think you know, if for those of you kind of experienced or have seen this before, it'll make sense. For those of you who are really, really new to this, you know, I'm sure that there's a little bit of that was a little bit confusing, but you know, feel free obviously to reach out to us. There's lots of other resources as well that you can go to find more information on cap tables and the like. And I'm sure that you'll be able to find other examples of high level cap tables that'll at least assist you when you're kind of first starting out, because really in the beginning, it's not going to be too complicated. It's going to be, you know, relatively straightforward with common shares and maybe kind of the first round of preferred shares that you're looking at. Okay, so there's some other stuff here. You know, in addition to the cap table, there's, you know, things like, you know, having ledgers, you know, which is just, you know, kind of like, you know, general summaries. You know, it'll contain a lot of the same information. And you know, who owns those the ledgers and who owns the cap tables and all that. You know, we highly encourage, you know, you as the founder to obviously keep your finger on the pulse and make sure that you know everything that's going on with your cap table. You'll you know, typically have ledgers that are able to be printed or downloaded from any software that you're using. Stock certificates. So whenever there is any kind of a purchase or distribution of shares, there will be physical, in most cases, physical stock certificates that are drafted. Typically, this will be done by your law firm that you're working with, and stock certificates will get distributed out, and that's kind of the physical form of the ownership of the shares. All of the ownership documents. Obviously you want to make sure that you keep track of it all. We as the founders, as the company, need to, have copies of everything that's being distributed to investors. We need to, obviously keep track of all of the reports that are being generated, all of the changes in the cap table that are happening over time, so that we can recreate those if needed. And if there's ever any kind of question as to someone's ownership of a company or what have you, we obviously need records of that. And obviously any investor who's investing in our company needs to be keeping all of their documents in a safe place as well. And then I'm not sure, in terms of, other things like, one big question we get is, okay, so this sounds kind of complicated. How do we keep track of it all? And, there are different ways of doing it, right? So, we highly encourage the second bullet point here. Which is basically using a software as a service service to keep track of your cap table, your shares, your reporting. It does all that. So, Carta is a big one. CapShare is another one. I'm sure that there are others out there. These are the two that we typically see the most often with our early stage companies. And basically what they do is, like I said, it's a software as a service. So you just kind of sign up and you kind of pay as you go. You can start off small. The pricing is such that, when it's a really early stage and then your cap table is simple and there aren't a whole lot of users, like a whole lot of investors or employees, then it tends to be very, very inexpensive. And then obviously as the cap table increases in complexity, increases in the number of rounds, increases in the number of investors and stakeholders, then it obviously gets more and more expensive as it gets more and more complicated. But I think you'll find that even at an early stage, that signing up for like a Carta or a CapShare is going to be helpful to you. It's gonna first of all give you good confidence that things are up to date, that you can run reports, you can perform compliance, you can do lots of things. Obviously run scenarios, which is another key one that we get asked a lot about, like, hey, listen, this is what our cap table looks like today. We really want to kind of understand what the impact is, if we look at a round of financing and we structure it in different ways, what does that mean to us? What does that mean to us as founders in terms of the ownership of the company? And we found that, you can obviously model that out in Excel, but that these services provide a much more automated, much more robust way of doing these kinds of analyses. So we really highly recommend it. If you're really early stage, right? If it's just you, maybe one or two other co-founders, you've really only got common stock. Maybe you've kind of already gone to the effort of looking at hiring employees, and so you've kind of worked with a law firm to set up a stock option pool, and you want to keep track of that. You can certainly start with a Excel or Google Sheets and kind of keep track of it that way. But literally, as soon as you look to raise a first round of financing, and you're going to have some preferred shares on the table, and you can have outside investors, then we highly recommend that you move upstream away from spreadsheets into a software package. And then there's other, you can purchase cap table software. We see that less and less and less. Actually, what we see more often is that law firms, right? Law firms use cap table software to kind of, keep track of, their clients' cap tables. And so, using that, then you'll get similar types of things as Carta and CapShare. I'm not so sure if there are any other benefits of using or purchasing cap table software as opposed to using a Carta or CapShare. Ala, do you have any thoughts on that?
Frankly, the cap table software itself is just kind of extended Excel or sophisticated Excel spreadsheets. And there are cap table software for larger companies, but I think for early stage companies or companies just starting, either the Excel route, doing it yourself, or using either CapShare or Carta is really the way to go. Just like all SaaS type applications, the bigger you are, the more expensive these CapShare and Carta become. So you might want to look at some of the more formal cap table software packages that are out there. And the only times, the Sirk, that I've seen it, I know that there's one very large law firm here in the Valley that has their own proprietary cap table software, and I'm sure there are others out there that use it. But I think in the world we live in, it comes in two flavors: the spreadsheet that somebody has created either in Excel or in Google Sheets, or a CapShare Carta type structure. A lot of companies might be actually, their law firm itself might be using one of these two SaaS options to do it. And as kind of a side recommendation, at some point, if you have a lot of option activity, you might really want to look at your cap table management cost. A lot of companies just kind of go the default when they first start. Their law firm will say, hey, we'll take care of this for you. And initially, when you don't have that many transactions, that might be the way to go. But then all of a sudden you're hiring employees, you're having people exercise options, you're granting new options, you're doing various fundraising. All of a sudden your cap table management cost goes through the roof. As a paralegal at one of the large law firms is charging you anywhere between $400 to $600 an hour to input a new option grant. So this is something that you should be aware of, and sometimes bringing that cap table management in-house through a CapShares or Carta might be a little bit more cost effective if you're a larger, if you have more employees and more activity. But the one thing that I want to kind of piggyback on what you said, Sir, a cap table is really an important thing to keep current. Some of the issues that I see is if a company, for example, is going through an M&A transaction and they haven't kept a good cap table with good current investor lists and addresses and contact information, you might be in a situation where you want to sell the company. And you require shareholder consent. All of a sudden, you're kind of now struggling to see who are the shareholders and how you could get a hold of those folks, and how many shares do they own, and have you captured the requisite number of shareholder approvals out there. So having a shareholder list that's current, that has everybody's latest addresses or contact information that you could go to and slice and dice in any way that you need for M&A transactions is super critical. The next thing that I also see in early stage companies that should be kind of a warning sign. It happens all the time where companies don't have a lot of money. They'll go to a consultant and they'll say, hey, if you do this for me, I'll give you X number of shares, or I'll give you a certain percentage. And it's a verbal thing, or even there might even be a formal agreement, but it's never memorialized because the company is in its early stages, and now you're getting ready to do a formal venture capital funded round, and everybody comes out of the woodwork that you had forgotten about. So keeping that cap table, keeping a list of of either warrants or options or consulting promises that you might have made during the early stage of your incorporation is really important, because when it's critical, whether you're raising a round or an M&A type transaction, these things tend to be a big limiter and really slow down the process, or it could be very, very expensive.
Yeah, Ala, that's a really, really great point about the management of your cap table and your software. I've certainly seen that many times as well, where we have clients who use their law firm to kind of manage their cap table, and I can tell you that it's going to be very, very expensive venture. Especially early on. Obviously, you don't want to be spending money on things that are not adding value to your company, right? And not that not that the cap table isn't valuable, it certainly is, but paying someone big dollars to keep it maintained and updated with individual transactions really doesn't make a whole lot of sense, right? And so another reason why we recommend something like a Carta or a cap share is because now you have control over it. You can give access to your attorneys. You can give access to your finance folks, right? So for example, Ala and I, as consulting CFOs, we typically have access to our clients' Carta or cap share accounts, right? And so a lot of times we're able to do some of the similar things that an attorney would normally be asked to do in terms of like writing reports and getting creating updated cap tables and things of that nature. Either you can do it, or you can have somebody like us who obviously are experienced and know exactly what level of detail we should be giving out to certain people. You could have us be doing it, and the idea is that it's just going to be a whole lot cheaper, and you're going to have more. You're going to be more knowledgeable and hands-on with the stuff, which I think is important as a founder for you to have experience and get more experience and learn more. And the best way of doing that is obviously going in there and doing things on your own.
And one final thing, as I kind of remember, one of the things, if you're a company that is now rolling and you're issuing options, you're going to have board approvals for the option grants. A cap table management system makes that whole process really easy, where you're able to get board consents electronically. All these software packages have that board consent that you could just, by pressing a button, generate very, very easily. Communication to your option holders, having a formal package makes that communication a lot easier. And finally, just having things in the cloud and not having actual papers go back and forth either through the mail or whatever in snail mail. A lot of these systems allow you to do, with the help of your law firm, of course, and have the appropriate agreement behind it, electronic share issuance, stock certificates, and electronic signatures. Just makes the whole process a lot easier. But again, it makes more sense when you have a lot of activity than when you're just starting out.
Fantastic. So, I'm not sure if you're able to see the chats, because I actually can't see them. Would you be able to go and kind of read off some questions that have come through? I think I saw one earlier, but I'm not. I don't have visibility.
On the chat front, the one thing that I see on there is going back to the summary slide and making it larger, the summary cap table slide, and making it larger because it was very, very hard to see. I think that was probably the only comment that I got. Now I see some things on the Q&A side. The first question has to do, Sirk, with how would you quantify the value of your startup to get funding? And I think that relates to the pre-money valuation. Would you like to take that?
Sure. Yeah. So that's right. So we get this question a lot from from founders at an early stage, right? And that is that, okay, how do I value my company, right? Like, what is my cap table supposed to look like? And how do I leverage what I know to be able to negotiate, the best deal for myself and for the company when we go out and look for outside investors. And so there isn't really, there are obviously some guidelines. There are, some ranges, that you can at least start with. But ultimately, it's really about, every company is different, right? So if you're at an early stage, some of the factors that are going to go into it, as I mentioned before, are things like, how big is the market, right? How big is the market that we're going after? How much progress have we made? Where are we in terms of product development? Do we have product that's already selling, or are we in product development mode? How much of an effort is it going to take, right, for us to get to where we need to get to? What's that investment looking like for us? And what's the roadmap that you can show that's going to be compelling to investors, that the money that they're investing today is going to be worth a lot more in the future, right? Because that's ultimately what they're investing in. How much revenue do we already have customers? What kind of revenue trajectory are we seeing, and for how long? What kind of a history do we have, and can we extrapolate that history? How much money have we put in, right? How much money have others put in? What does the balance sheet look like today? How much cash, how much runway do we have? How much interest is there in from the investment community, right? So, we can talk a lot about, well, we think our company's worth this, but the real fact of the matter is that it's going to be an imperfect model, and ultimately you're going to have to make an argument as to why the valuation that you're seeking as a pre-money valuation is appropriate to outside investors, right? And so if you have 2 or 3 really, really interested investors who want to lead around the financing, I guarantee you that your company is going to be worth more than if you have one lukewarm investor who might put in if the terms are just right, right? And so there isn't a science to it. There is more a matter of art and a more matter of kind of negotiating ability on your part as the founder to be able to argue the value proposition of the company, of the progress that you've made, of the opportunities, and ultimately kind of selling this vision to investors that you're going to make them a lot of money with the investment that they're going to be coming in with. Now, having said that, obviously, if this is your first round of financing, equity financing, you haven't brought in outside money. Maybe you've invested a little bit of on your own. Maybe you've got some family money, and now you're looking to kind of blow it out. Well, you can go out and you can look at things like comps of other companies that may be similar in industry, comps of other competitors or potential competitors that you're kind of going after, if that makes sense. Comps of other companies that you can research, right? In terms of in investment communities, there's lots of information about companies getting funded, and how much they're raising and things of that nature. So all of that can be taken into account. But ultimately, it's going to be about what you can sell to investors, and what you can argue to investors as being an appropriate valuation.
Yes, and I want to kind of echo that. There is really no formula that you're a AI company, or if you're an e-commerce company, this is what valuation you should get at whatever stages. Valuation also has nothing to do with the assets that you have. I mean, it might have something to do with the cash that you have, or but if the computer value or some of the fixed assets typically don't come into it. Early on, it is some kind of a negotiation based on your investors' experience and other investors' experience and comparables in your space at whatever stage you're in. At some point, if you're generating revenue, the discussion in valuation tends to revolve around revenue multiples if you're a technology company. And those revenue multiples are also all over the place. Sometimes they look back a year, sometimes it's looking forward a year or two or three and determining the valuation. So I know it's not an elegant answer that we're giving, but I don't know of an elegant valuation scenario for startup companies, especially in the technology world. It seems to be all over the place. We can tell you that if you're a service company, the valuations tend to be typically around revenue, and the multiples are usually very low, anywhere in 1 to 1.5, maybe 2x in a rare instance, but that's typically where they are. So I hope we answered that question. The second question, Sirk, revolves around the ownership of both. I know that CapShares is now owned by Morgan Stanley, and Carta is now a public company. So this one participant is wondering if we have any comments related to that. I would assume around conflict of interest, and would we still recommend it? I'd like to just, we actually had a call with a bunch of these companies, and we've asked those questions, and we're assured up and down that the management of these companies is still independent, and that the fact that they're owned by, that they're either public or are owned by larger, investment banks like Morgan Stanley, will have nothing to do with the way that they run their operation. And frankly, really, the bulk of their business is not companies that are just about ready to go public anyway. It's a little bit, it's a lot of smaller to medium-sized companies, and really have not experienced myself any kind of conflict of interest right now. Sirk, do you have any experience with that?
No, that's exactly right. I would not take that as kind of a decision-making point to choose one or the other. What you just said is spot on, Paula.
And correction, Carta is not a public company. It's okay. One more.
Paula?
Yeah, there's the question really relates to the offering from Carta and CapShares around 409A. I think we have some comments related to that. I know that they both probably offer these types of services, and a lot of times the pricing tends to be less than the standard 409A valuation firms. So do you have a comment around that, Sirk?
I do. I think, so 409A valuations, this is for just as a way of background. So basically 409A valuation, I kind of mentioned it at the top, is a study that's done on an annual basis or after big significant events where an outside company is supposed to come in, a third party is supposed to come in. They're supposed to help determine the value of the company based upon lots of different factors, but trying to estimate the value of a company's common shares so that when you are giving stock options or when you're giving common stock, that it's being done at a strike price that is fair. Right. And this kind of really came out in the past because of, there were companies that were trying to game the system and they were undervaluing their common shares so that their employees could get, stock options at a really, really low price and things of that nature. So there were some regulations that put in 409A studies is kind of what is the industry standard to do these valuations. And as the question raised, these software platforms such as Carta and CapShare do kind of these. I would say there were partially automated studies, and then they put someone who's kind of knowledgeable about it, and they're able to kind of come in and do some subjective analyses. And between those things, the fact that Carta or CapShare has all of this data about how much has already been invested into a company, at what price, how much has been raised, how many rounds, the dates of those financings. So basically these software programs already have a leg up, right, compared to if you were to hire a third party to just come in and say, hey, we need a 409A study done, in which case then they would actually have to go in and do some analyses on the cap table itself before doing any other kind of comparisons to what's happening with market comparables and discounted cash flows and other things that people use to try to value a company. And so I'm a big believer that that I think for most companies, that a Carta or CapShare valuation methodology is absolutely appropriate to use. Now, having said that, there are absolutely some trade-offs, and I would say the biggest trade-off is that because they use kind of automated data, that they start with kind of a model, and someone who's an expert is supposed to come in, and they're supposed to kind of tweak that data, run different scenarios, and put his or her subjective touch to it. But it's still never going to be as I guess open to interpretation as someone coming in, like a real 409A valuation firm that is going to come in and do a full kind of grounds up analysis to determine the valuation of the company. And where that really matters to us as founders is that we found that that trying to get Carta and trying to get CapShare to negotiate, right? So this is kind of like after they put their draft report out, we're the founders, we read it, they give a bottom line, your common shares fair market value as of this date is X. Let's say it's 25 cents a share. It's our ability to actually kind of provide inputs into that and to hopefully negotiate a number, or to explain why we think that number is too high or too low. In most cases, we're going to be arguing that it may be a little bit too high, but it's a little bit more limited. When you're working with a firm that is kind of doing it from the grounds up, they're going to be working with us, more closely at the beginning stages when they're putting their model together, and they'll be providing inputs into, hey, these are the market comps we're using, these are the financial forecasts that we're using for our analysis, and we're able to kind of go in and say, hey, look, this market comp that you're using is not appropriate because of this reason, and a firm may be more amenable to listening to that and taking that as input. So that's really, probably the one area where I think using a service firm that specializes in company valuations, where that might be of benefit to us, as opposed to using a Carta or CapShare. Carta or CapShare is simpler, and it's cheaper, right? So those are the two benefits that you get. And like I said, it's already kind of tied into, to our software that we're using. It's all in one place. We'll always have easy access to it. We'll have records of it. And there's still an ability for us to try to go in and try to argue our viewpoint of valuation. But I found that, Carta and CapShare are less prone to, making significant adjustments to a draft report than if we were to work with someone, a firm from the beginning.
The other kind of potential limitations to CapShares and Carta is because of the automated nature of their valuation. I think Sirk hit on one point, but I have a company right now that is currently going through an audit. When you go through an audit, one of the things that a lot of the audit firms do is that early stage companies don't normally do on their financials, is do what's called a deferred compensation entry or valuation on their financials. So audit firms typically do that. And a critical part of that audit procedure is to determine the value of the common shares or the stock options that were issued. They don't normally just take the 409A valuation and say, okay, they do audit work on it. And in two of the cases right now, those firms have, audit firms have asked for detailed discussions with the 409A valuation firms in their underlying assumptions and what they did to create, to get to the 409A valuation. If you go to a firm that has been doing this, that is still around, and you could typically talk through, the auditor could talk to the folks doing the valuation to get an understanding and then make a determination. I have not gone through this myself, but the notion out there is that will be a little bit more difficult to do with large organizations like Carta and CapShares, larger organizations like Carta and CapShares, when they have an automated process that may not be, you may not have an individual to talk through the valuation process in that. And finally, again, this is something that I haven't experienced myself, but there are discussions out there that if you were to get audited by the IRS and you have the cap table management done by the same firm that is doing your 409A, that may generate some kind of issue with the IRS in that you have the same company that's doing your cap table management also doing your valuation, so there might be an independence issue there. Again, I've not experienced that personally myself, but that's some of the discussions that I hear out there.
Thanks, Ala. That's great. And I know we're already over the hour, so so we'll go ahead and end it here. Again, our apologies for the technical difficulty that we had today. As you can see, you know, I am not the best at managing the actual presentation. Jerisa, our marketing manager, who is typically our moderator, was having difficulties. So please don't hold me to you know, our initial promise that we're going to be sending out this presentation. I think that's what's going to happen. I think that Jerisa is kind of in the background and recording this, and we'll make it available to you. That's typically what our normal process is, and hopefully you'll be receiving an email from us within the next 48 hours with a copy of the presentation as well as the recording. In the meantime, thank you so very much for taking time out of your busy schedules to join us today, and we will see you. We will talk to you next time. Okay, take care, everyone. Thanks again.